from wherever you might be joining me from today. Thank you and welcome to Put Options Trading for Beginners video presentation. My name is Dr. Samuel Adebayo. Before I go into this presentation, kindly subscribe to this channel. That is the only tool that will get us from where we are to where we want to go. And we also help this video to reach all the areas it needs to reach. Also share this video and smash that like button. We are expecting nothing less than 1,000 likes for this video, so smash the like button. So let's get into it. Put option trading for beginners presentation. In this video, I will explain the meaning of put option, how you can make money buying or selling put options, how you can also lose money doing that, and what to look for when choosing the underlying assets for your put option trading. So the question that you might want to ask is, what is actually a put option? A put option is a contract between two people, that is the buyer and the seller, giving the buyer the right to sell 100 underlying assets, which is stocks, bonds, commodities, indexes, and currencies, at a set price, which is the strike price, and set time, which is the expiration. So for any put option trading, there must be a strike price and also the expiration date. So I am going to use this scenario on my screen to illustrate how put option trading goes down. Let's pretend that I am the seller on this left corner and on this right corner, and we have the buyer on the left corner here. So I am giving the buyer the option to sell a contract of a bushel of corn at $4.50, which is the strike price, to me in 2 weeks, which is the expiration date, at a premium of 25 cents, because this contract is not for free. So the buyer is going to buy the right to sell this bushel of corn to me at the price of $4.50, which is the strike price, in 2 weeks for the premium of 25 cents. And since you have 100 securities in one contract, that means 25 cents times 100 will be $25. That will be the premium that the buyer will pay to acquire this contract. So another question that you might want to ask is, using this scenario, how can then I make money as a buyer, or how can I lose money? Even as a seller, how can you lose money? How can you make money? Let's look into that. How you can make money. The buyer makes money when the asset price drops. When the buyer purchases this contract, his hopes and aspiration is for the price to drop below $4.50. And voila, it's his lucky day. The price of a bushel of corn dropped below $4.50 to $3.50. Okay, so the buyer will then buy the corn at that lower price of $3.50, and in turn sell to the seller at the price of $4.50. So the profit will be $4.50 minus $3.50 minus the premium will be 75 cents. So since one contract is 100 securities, the total profit will be 0.75 times 100, which is $75. That is not bad on one trade. Okay, and better still, if the buyer purchased more than one contract, let's say the buyer purchased 10 contracts. So all you need to do is multiply this by 10, and that is $750 in one trade. That is a very good day, right? So that is how good buying and selling option can be if you are able to understand what to do and how to do it. So let's see how you can lose money. The buyer will lose money when the price of the asset rises. So let's say the price of a bushel of corn rose to $4.90, right? The buyer will not exercise the option because the contract is worthless. Yes, why will the buyer want to sell for $4.50 when the current price is 490, you know, rather sell for 490. So the contract will go worthless, and the buyer will only lose the $25 premium that they paid to acquire this contract. And this $25 will be going to the seller, okay? The seller don't have to do anything because he doesn't have to purchase the bushel of corn at 450 because the price did not drop below 450. So the buyer is just not going to do it, he's just going to pocket this $25. So choose right. It is very, very important to choose the right company to trade your put options in. The good company to trade will be high value and stable companies like Apple, like Dell, like Amazon, and reputable companies like that. It has been proven over time that you have stable string of profits while trading this kind of organization. Also sell further out of the money, which is OTM strike prices. These are out of the money strike prices right here. Anything further from the out of the money strike price right here, you are going to make profit. Okay, you are going to make profit, and we are going to demonstrate that very soon. So also choose a company where you are comfortable owning 100 shares of stock. So there are times when you are buying or selling puts that the shares will be assigned to you. So you want to be sure and be confident that the company that you are owning the shares in is a company that you really want to own. You like that company, you know it's a reputable company, it's viable, and you have stable dividend from that company. So those are the kind of company you want to make sure target when you are buying or selling your put options. So possibilities, we have lots of possibilities when trading options. So let's quickly do a live demonstration. I am going to unshare my screen. So I am NKLA is Nicola. So NKLA, which is Nicola. Let's do our test run with Nicola here. So I'm going to say trade Nicola options. I'm going to select put, and I'm going to select sell. So now looking at Nicola options here, you can see you can see break even. The chance of profit here is 60%. Okay, so let me select this. And I also told you that you stand the chance of making more profit when you sell further away from the out of the money strike prices. These are out of the money strike prices. These are in the money strike prices, and this is at the money strike price, which is where you have the price of Nicola shares. So I click on this. I would say it's going to ask me how many contracts I want to buy. Do I want to select the limit price to be the bid price or the ask price? Let me say is the ask price 0.06. Okay, 0.06. Okay, and I'm going to say review. Okay. So you can see right here, if I click on submit, okay, so I am selling. Oh, actually, let me see here. You can see the chance of profit is 69.39%, the chance of you making profit. And if you sell further away from the out of the money strike price, you have 0.5 here, you have 90.28% of making profit. So let's say I am buying just one contract. I said submit. Okay. And let me see. Let's say submit. I'm not going to go into all of that. When you click submit, and then you can just swipe up and you will have that contract. So if the price drops below $1, okay, because you are buying your strike price is $1, and you are paying the premium of 2 cents to acquire that contract. So if the price drop below $1, okay, the buyer will make profit, okay. But if the price stays above $1.03, then the buyer will not exercise the contract. The contract will be worthless, and it will just lose the premium that he paid for this option trading, and the seller will in turn pocket that premium. So that is how you trade option trading. Is very, very easy. So in our subsequent video, because I don't want this video to be very, very long, we are going to be talking about different strategies for trading put options, and how you can use those strategies to also make money or lose money. We are going to be talking about all of that. Till the next video, see you then. Don't forget to subscribe to this channel, like, and share. Thank you.